All right, today we are taking a closer look at Zeroda's new Sensex Index Fund. We're going to break down exactly what it is, how it works, and maybe help you figure out if it's the right kind of thing for your portfolio. So let's just dive right in.
So let me start by asking you a question. What if you could own a tiny piece of India's 30 biggest and most important companies for about the price of a good cup of coffee? I mean, really, that's the whole idea, the core promise behind this new fund.
So, how do they make that happen? Well, Zeroda has just launched what's called a new fund offer, or an NFO. You can think of it as their public invitation to be one of the very first investors in this brand new mutual fund. Now, this launch has a pretty specific timeline. The NFO period runs from October 20th all the way to November 3rd. During that window, you can get in at a fixed price. But what happens after that? Well, it just becomes an open-ended fund. That's just a fancy way of saying you can invest or take your money out on any business day at whatever the market value is at that time.
Okay, hold on. We've just thrown a few terms around, like NFO and index fund. Before we get any deeper, let's just take a quick second to decode that jargon. Make sure we're all on the same page, because this stuff is the foundation for really understanding what you're putting your money into.
So, an NFO, what is it? Honestly, the easiest way to think about it is like an IPO for a stock. An initial public offering? It's the exact same idea, but for a mutual fund. It's that very first chance for the public to get in on the ground floor.
And that brings us to the index fund part. So what's an index fund? Its goal is actually super simple. Instead of having some genius fund manager trying to outsmart the market and pick winning stocks, an index fund just copies the market. It aims to mirror a specific index, and in this case, it's the BSE Sensex. It gives you a slice of India's top 30 companies. And this strategy leads to a really crucial difference.
And that's the difference between passive and active investing. The Zeroda fund is passive. It's on autopilot, It just tracks the Sensex, no questions asked. Active funds, on the other hand, have a manager who is actively buying and selling, trying to beat the market. And all that activity, it usually comes with much higher fees. The passive approach is famous for being low cost. Now, to be super specific, this fund tracks the BSE Sensex Total Return Index, or TRI. That total return part is actually a really big deal. It means the fund doesn't just track the stock prices going up and down, it also automatically reinvests any dividends those companies pay out. Over time, that can make a real difference to your overall returns.
All right, enough with the concepts. Let's get down to the brass tacks of this fund. These are the key details, the numbers you actually need to know if you're thinking about this.
So let's just run through the vitals here. It's open-ended, that's your flexibility. It's large cap, so it's focused on India's biggest, most stable companies. And it's a direct growth plan. Direct is great because it means you're buying straight from Zeroda, which cuts out middlemen and keeps costs low. And growth means any profits are just plowed right back in to help your investment compound.
And there's that number we started with. The minimum investment is just 100 rupees. That's it. This makes it so accessible for pretty much anyone. Whether you want to do a one-time thing or start a small monthly investment, an SIP. Here's another number I think you'll really like. 0. There is no exit load. What does that actually mean for you? It means if life happens and you need to sell your units, you won't get hit with a penalty fee for doing it. That's complete flexibility.
Okay, now for a very, very important reality check. Just because this fund is simple, it does not mean it is risk-free. Far from it. SEBI's official riskometer rates this as very high, and that's because it's an equity fund, it's invested in the stock market, and as we all know, the market can be volatile. Its value is going to go up and it's going to go down. So who are the people actually steering the ship here? It's always a good idea to know who's behind the scenes, so let's take a quick look at the management. The fund is managed by a gentleman named Keda Nath Marriagekar. He's bringing over a decade of experience in the mutual fund industry to the job, and he's got a solid background in finance with past roles at big names like ABSL AMC and HDFC Bank. And the fund house itself is, of course, Zeroda Asset Management. It's the mutual fund arm of the Zeroda you probably already know, and their whole game is building these kinds of simple, low-cost, index-based products for regular investors.
Okay, we've covered the what, the how, and the who. But that brings us to the final and, let's be honest, the most important question: what about you? Let's try to connect all these dots and see if this fund actually makes sense for your personal goals.
So, who is the ideal investor for a fund like this? I mean, who is it really built for? Because it's definitely not a one size fits all kind of deal. Let's see if this sounds like you.
This fund is probably a really good fit if you're someone who is in it for the long term. You're seeking long-term growth. You want to be invested in India's biggest companies, but you don't want the headache of picking them yourself. You love the idea of a passive, low-cost, kind of set it and forget it strategy. And, this is the big one, you understand and are comfortable with that very high risk level that comes with investing in stocks.
And that leads us perfectly to the mandatory but absolutely essential reminder. Every investment has risks. You've seen this line before, but it's powerful for a reason. Please always read the scheme documents carefully before you invest. Do your homework.
So, we'll just leave you with this one final thought. This entire fund is built around the idea of simplicity. And the question to ask yourself is this: in a financial world that's getting more and more complex, could simplicity be the ultimate investing advantage after all?